Perfect. Good morning again, everybody. We are now live on YouTube. Hundreds of people across the country have joined to attend this program on a Sunday morning, 11 o'clock. I'm from Calcutta, Brijesh Dalmia, and we have on board with us today Mr. Varun Misal from ICICI Prudential Asset Management Company. Welcome, Varun. Can you hear me, Varun?
Yeah, I can hear you. Can you hear me, Brajesh?
Yes, Varun, loud and clear. Thank you so much for joining and taking time out today on a Sunday morning. I know it's an off day, but then again, we are doing this an investor meet today, and most investors are free on Sundays, and we are doing this event today. So we have a lot of people joining in. Maybe we have people who have joined in. Can some of you, the participants, mention your name and the city from where you have logged in quickly on the chat box? Can we see a flurry of name and city so that we know? Nagpur, Yuvraj, Prem, Baroda, Jaipur, Bangalore, Atanu Padar, Pune, Baroda, Sony. Oh my God, I have lost track. Mysore, Abu Dhabi, Delhi, Udaipur, Ahmedabad, Brijesh from Amravati, Varanasi, Mumbai, Bhilwara, Sonpat, Coimbatore, Bangalore, Jamshedpur, Guntur. My goodness, Siliguri, Nagpur, Dubai again, Singapore, Mumbai, Ankleshwar, Ahmedabad, Pune, Chennai, Pondicherry. Fantastic. So this is it. Kolkata, my city. Andhra Pradesh, Baroda, Amreli, Betul, Anand, Punjab. As I speak, 400 people currently are on board almost. Klarkov, Apurva, Mumbai, Abu Dhabi, Gandhidham. We are going to have a fantastic session today, and the timing of this program couldn't be better. Beating the volatility the smart way. And when we launched this event, volatility was there, but we are in the middle of one of the highest levels of volatility investors have seen in the last 2 years. And today we are going to address that. आज हम लोग ये बात करने वाले हैं कि आप volatility को कैसे beat कर सकते हैं, उसका एक smart तरीका क्या है. Thank you so much. Keep the information flowing, investors. Please continue to mention your name and the city in which you are. और अगर आपके कोई questions है तो आप chat box पे लिख सकते हैं. Better होगा कि अगर आप Q&A box पे अपने question लिख सकते हैं, and we will answer after the presentation. We promise you the event will not be more than 30 minutes, and then we will take 10-15 minutes of your questions. So all of you can be relieved after 35-40 minutes of today's session. Around 11:45, we intend to finish the program. So without much ado and without spending any more time here, I want to ask you, Varun, इतनी volatility है market के अंदर में. How to address this volatility at ICICI Prudential? How do you handle volatility? Can you give us some answers to this?
So thank you, Brajesh, and a warm welcome to all of the participants. It's very heartening to see that people across, India and from abroad have joined. So first of all, thanks on behalf of ICICI Prudential AMC, and thank you, Brajesh, for giving this opportunity to us. So coming back to your question that how do we handle volatility? Now, volatility is something which is a given. Now, if you look at, the way the markets have behaved ever since the markets came into, its inception in India, there have been times when the markets go up and down. And this is something which is a given. Now, the whole point is that क्या हम ऐसा कोई solution, बना सकते हैं जहां हम उस volatility को beat करें, क्योंकि volatility या market का उतार चढ़ाव तो given है. There are multiple factors, and we can go and I can go on and on explaining कि इस factor की वजह से market आज ऊपर गया या इस factor की वजह से नीचे गया. Last 1 week we've seen because of a lot of announcements which were happening, you see the markets have gone down. अगर मैं just example दूं, इस साल के first month में जनवरी में you had a situation जहां 15 दिन market down था, फिर after 15 days the market went up. So this is something which is given, ये रहेगा. और जब तक equity markets हैं, and ये शुरू से था, जब से equity markets का इतिहास अगर आप देखें तो markets up and down रहेंगे. The whole point is that can we have a solution where we can make volatility our friend, and can we beat it? Can we have a solution जो volatility की वजह से इन्वेस्टर्स के लिए रिटर्न जनरेट कर सकता है, क्या ऐसा सोल्यूशन है? तो हमें लगता है हाँ, हमारे पास एक सोल्यूशन है, टाइम टेस्टेड मॉडल है, एंड द होल आइडिया इज टू डिस्कस दैट, टू कट योर द लॉन्ग स्टोरी शॉर्ट। वॉलेटिलिटी रहेगी, हमेशा रहेगी, और कुछ हद तक अच्छा भी है, बिकॉज अगर मार्केट में इन जनरल मैंने तो जब एमबीए के डेज में सीखा था कि भाई आप स्टॉक में इन्वेस्ट करोगे, जब वो नीचे और वो जब ऊपर जाएगा तभी आपको उससे लाभ होगा। तो अगर खाली ऊपर जाता रहेगा तो it becomes very difficult for it to be sustained. So you need volatility also. Let me put that into perspective.
So, Varun,
And
just to interrupt you here, हर इन्वेस्टर की ये चाहत होती है, एवरी इन्वेस्टर हैज दिस विश, ऊपर बेचना है, नीचे लेना है, यू हैव टू सेल हाई एंड बाय लो. इज इट प्रैक्टिकली पॉसिबल, yes or no,
so
with the solution that you are going to provide?
yes, I think and we have that solution. But होता क्या है, it is very easy. आज अगर हम discuss कर रहे हैं, when we are discussing, it is a very simple way of putting it कि भाई मैंने खरीदा, जब मार्केट नीचे था मैंने खरीदा, और मैंने जब मार्केट ऊपर था मैंने बेच दिया. बट प्रैक्टिकली ये करना बहुत मुश्किल है, इसमें बहुत सारी चीजें इन्वॉल्व होती हैं. सबसे बड़ी एंड दैट इज more to do with the behavioral aspect, that it is very difficult to pause yourself when the market is up and आप market से निकले, and vice versa जब market नीचे होता है, there is so many negative news which is there, and today we all are in the age of social media, so much of information that comes. तो बड़ा मुश्किल हो जाता है वो डिसीजन लेना कि आज मैं अगर इन्वेस्ट कर रहा हूँ कहीं और नीचे ना चला जाए. तो ह्यूमनली it becomes very very difficult. But क्या सिस्टम बन सकता है? I think we have that solution where the idea is that without taking emotion, then इसमें सबसे बड़ी चीज होती है, जैसे मैंने पहले बोला, that decision to do it, कि मार्केट अगर डाउन है, क्राइसिस है, उस समय करेज है कि नहीं इन्वेस्ट करने का. एंड सिमिलरली व्हेन द मार्केट इज अप, whether you want to come out of that market or not, because हमको लगता है अभी तो ऊपर जा रहा है तो शायद और ऊपर जाएगा, कहीं मैं मेरा डिसीजन टू कम आउट गलत तो नहीं है. तो हमेशा वो जो डिसीजन मेकिंग होती है, जो बिहेवियर होता है, बात करते समय, पॉइंट रखते समय, इट्स अ वेरी सिंपल थिंग, बाय लो एंड सेल हाई, बट इट बिकम्स वेरी वेरी डिफिकल्ट टू इम्प्लीमेंट.
So,
एंड
yeah, perfect. So I presume you have a short presentation to show about volatility or anything else. How do you like to proceed?
So, really, I think I will take up the presentation, if that's fine, and then जो भी questions होंगे,
Perfect.
as आपने जैसे आपने बोला कि we can put it on the chat box and we'll try to address most of them.
Perfect. But there are people asking about English and Hindi. This is always an issue when we do webinars. So we will try to keep 70-80% in English, 20% to Hindi. आ ही जाता है because we live in India. So, but to address this question of all participants, we will try mostly in English, but we will add a flavor of Hindi in between. Proceed, Mr. Varun.
Thank you. So coming, as I said, if you look at the topic also, the topic that we've chosen is that beating volatility the smart way. And as I said, volatility is something which is given. If you look at even the past records, so our markets came into being from 1978 onwards. If you look at from that point, from 1st April 2000 for 1979, if you see, there have been multiple years where the markets have been volatile, or let me put it this way, where the returns have not been on the positive side. But one thing which is given, that markets will tend to reflect whatever is happening in the economy. So if the economy is growing, and we've all seen in the last, specifically post liberalization, way the economy has grown, and that is what is reflected in the markets also. And this, despite the fact, if you see, out of 41 years, there were 9 years where the markets gave a negative return. And if you look at the reasons, and I've tried to put some reasons which builds volatility. So in that 41-year-old journey, you had major financial crisis, some of it we know, which became headlines, came in the headlines of papers. You had 11 different governments. So if you look at in that period, there was fair amount of political instability also. Okay, now we are used to it that we've seen for the last 15-16 years. First you had 10 years of one party's government, and now you had a 5 year, and then again that government got re-elected. But if you see, before that there were 11 different governments, specifically in the phase 89 to 98. You had so many changes of government which took place. You had natural disasters, so whether it is a tsunami which hit us, or where there were major earthquakes which happened. So a lot of things were there, and because of that, volatility was created. Despite the fact, if you look at the way the markets have behaved, despite volatility, the markets still have given a return for somebody who has invested. So to cut the long story short, agar kisi ne has invested 100 rupees, that 100 rupees from 1st April 79 has become 55,566. So that itself tells you that while equity has remained volatile in the past, the fact is that if you stay invested in the market, and that is something I'm sure all of you, when you would have met your advisor, or when you would have read anything about the market, the one thing that's a common thing which is said is that you have to remain in the market to generate that returns despite volatility. And there will be a lot of reasons, and I said I elaborated some of the points in the recent past, and we believe that that trend will always continue. There will be political events, there will be the way we are a country like India will be affected by what happens to the FII flow, what happens to the RBI and the government policy. If you see last 7 days, you had a situation where because of the announcement you had market correction. So this is given, and then there is the unknown factor. Like, I mean, in March 2020, we never knew that we can have a situation that for 6 months we will all be at our houses and we'll be working for there. So that is the fear of the unknown is also there. So one thing which is a certainty, and which is something which has always been there in the past and will continue to be in the future as well, is volatility. So now the question that comes is that how do you tackle that volatility? It's very clear, as I said, and we were discussing with Brajeshji also, that the markets will never be one way. It will always be upward sloping, but volatile. So if you see last 41 years, it's only 9 years that the market has generated on a yearly basis a negative return. Most of the years the return was positive. But was it always going up? The answer is no. The whole idea is to remain invested, or can I have a strategy where what we discussed, that what is the right thing to do? Buy when the market is low and sell when the market is high. Humanly, it becomes very, very difficult to practice, very easy to talk about, discuss, but very...
Can you go to the previous slide? This is very interesting, the ECG one.
Yeah.
So on the first slide, you saw that markets went down by 7 or 9 times over the last 40 years. And almost 32 times markets went up on an annual basis. But this slide is very revealing. ये slide में हम क्या देखते हैं? What we see in this slide is that even during the year, there were a lot of times markets were going down and going up. It is spread very evenly. Annually, you make return, but within months, markets go down and then it goes up. So this is real volatility, isn't it?
Yes, and that is why if you see the topic of the slide also, we said that it is like Sensex ECG, and this is something which is a given. It will always be there. The whole idea is that can I have a strategy, or can I get the better of this, because this is something which is given. This will always be there, and can we have a smart solution for ensuring that despite this, without taking undue risk, can we generate?
I have lost you. Has someone else also lost you, Varun? Can some of you mention if you are able to hear? Oh, all right. So maybe something to do with my connection. Varun, people have lost you, Varun. Maybe your internet connection is a little weak. Can you re-log in or something like that? We will have Varun very quickly. Yeah, Varun, you can share again. This is quite interesting, and I mean, I'm also excited to see the how ICSA can contain volatility.
I
We have
think there was,
500 people. Can you share?
yeah, I think I'll just share it. There was some
Yes,
issue with the.
no problem. Friends, please hang on for a minute, and Varun will share the slides shortly. Roger. So meanwhile, Varun is getting his technology in place. Friends, I think volatility is a part of life. If you're an investor, when things are going good, everybody thinks markets will go up. And when things go down, everybody panics. Some of them book losses. Today, we are going to discuss about a strategy, a scheme, a product where the buying and selling happens on its own. And so investors don't have to do anything. And this is a very long-term proven strategy, which we are going to probably show you in the next 5 slides. So just hang on. Any challenge, Varun?
Just a second, sir. I
Yes.
hope it is visible now.
Yes. You can make it full screen.
Yeah, I'm just doing that. Just a second. Hope
Yes.
I'm audible.
Yes. Yes. We can go to the
Yeah.
next,
So,
please.
yeah. So, as we were saying that, the biggest challenge that comes is that to decide when to enter, when to exit, and by, practical and Brijesh ji, you know it better than anybody else that we often end up doing exactly the opposite. We are fearful when the markets are down. That is the time generally that we come out of whatever investments we made, and when the market is up, when maybe probably it might not be the most prudent time to enter, we end up entering the markets. So can there be a strategy where we can do exactly opposite? We end up investing when the market is low, and we exit out automatically when the market is high. We believe that there is one such strategy, and that can be done within the fund. So
Okay.
can there be a scenario where we can do it? We believe that we have that time-tested model where it is bereft of all human emotions. So basically, it's not only just for the investors, even for somebody who is managing the fund, at times emotion plays a very, very important role. So can we have a scenario where we just take out the emotion aspect out of it? We believe, yes, we have that solution, and that solution is the balance advantage fund, and it has a in-house model where, to cut the long story short, what happens is that when the market goes up, and just to simplify it for all the investors, if at any given day the market goes up by 2%, we end up reducing the equity level of the fund by 1%. If the market goes down by 2%, we end up increasing the equity level by 1%. And I'll show that in the subsequent slides that how we've done it. So the whole idea is that we have an in-house model. The model decides what should be the equity level of the fund. So the fund is designed in a very simple manner that within the equity and debt asset class, it will move. When the markets are low, when the valuations are attractive, the equity level is high. And when the market is high or the valuation levels are high, the equity level is going to be low. So that whole dilemma that is there, that when to exit, when to enter, we believe that that is something which can be taken into account, and you shall come to that part how we've done it. So it's not just, so it's a strategy that we've been running from 1st March 2010, and now it is completed almost 12 years and running. And the whole idea is that while the fund is a very simple fund which invests into equity and debt, it follows the model where the model tells that if the valuations are lower, attractive, the equity level goes up, and vice versa. the equity level lies between a range of 30 to 80. So when invariably when the markets are low, when valuations are attractive, there's a lot of negativity, the amount of volatility is heightened, you have a scenario where the equity level goes up, and exactly opposite happens when the market is high. So
Can you
it's a
give an
very, very
example to this?
so the example to this is that and this is something which I tried of explaining it with data and with the kind of equity levels that the fund has maintained over the last 2-3 years only. And why I chose last 2-3 years, I could have shown a graph from 2010. This is something which we've experienced it. So we all know in March 2020, the moment the COVID pandemic break, and we had a situation where everything was shut down globally, the markets were correcting. That was actually a scenario where one should have gone into equity, but with so much of fear, negativity, people were panicking, and we all were having a dilemma that whether this is the time to enter into it. If you see, in March 2020, the fund actually increased its equity allocation to about 74%. So you had a scenario where 74% was in equity, you had the remaining 26% in debt and cash, and you compare it with, say, again, I'll give you one example, again, which we can relate. So April 2019, I think that was a time when the general election results were declared, and the current dispensation under Prime Minister Narendra Modi was re-elected, and that was a very from a news point of view, political next 5 years, things are moving, things are positive, the reform process to continue. But you actually had, if you look at the fund's equity level, we had reduced it, the model had reduced it to 38%. And today, even as I talk to you, when the markets have done reasonably well, despite the volatility that we've seen in the last 2-3 months, from that level that we were in March 2020, the equity levels have reduced. So if you see, in the period where the markets were low, where there were a lot of questions, where generally the decision to enter into equity was tough, you had an average equity allocation of 63%. And as the markets recovered, you had a scenario where the equity levels started reducing. So today,
So
even
let me
as I talk
summarize
to
it.
you,
Sorry again here. This is quite interesting. So the blue graph, for the benefit of the participants again, the blue graph on the left-hand side, which you see, is pre-COVID, and the average scheme equity holding pre-COVID was 49%. COVID came, markets crashed, the equity exposure of the investors' portfolio in this scheme went up to 63%. When everybody was selling, ICICI, this particular scheme increased the exposure to 63%. And then after COVID, November 20, after the kind of first wave, when the market started rising, again, the equity exposure went down from 63% to 36%. And currently you are around 35%, where index is around 55,000 last month. Interesting.
So, the only point is that, in the starting of the discussion, I said that, buy low and sell high. And, from an individual point of view, yes, at times it can be challenging. Not that it cannot be done, but here you have a model, here you have a process where exactly what we said, that's which is the ideal solution, to buy low and sell high. That is something which we've seen, and this is not something I could have easily shown the period in the last 12-year period, but just to ensure that this is something where we all of us who are attending this call have gone through and looked at this phase. As Brajesh said, if you see, it's exactly to the red line. So whenever the red line, which is the Sensex graph, is low, you invariably end up where the fund's equity allocation is high. And when, as the red line, which is nothing but the market movement, moves up, you had a
Varun, we again lost you, I think.
where from a fund's perspective, a very difficult process. From an individual, even if some of us have to do it, but here we have a scenario where where the fund is going to do that for you, and that is the beauty of this strategy. In fact, when we talked about, and during the talk, Brajesh specifically asked about that ECG slide, that was the daily movement. So while yes, on a longer term, you have this scenario where, when the markets go down, the equity level go up. Even within the phase where the market, is, in a range bound manner where you don't have, while you have volatility, but the movement is not that stark. The ability of the fund, the fact that, as I told, that, when the market goes up 2%, the fund will reduce equity by 1%. The market goes down by 2%, the fund is going to increase equity level by 1%. Even in those times, if you see, and what we've tried to show is that despite the fact that, the broader market, because it came back to the same level, the volatility was there, but you didn't have a very stark movement, despite the fact that, that was the scenario. The sheer fact that this fund has the ability to, change its equity level gradually ensured that even in during these phase, you had a scenario where the fund was, the strategy was able to generate positive returns, and more or less these returns are in line with the kind of returns that one expects in a traditional fixed saving instrument. So that was the whole idea, that, at a broader level, this strategy, any which way, it is stood the test of times. And even in times where, though there might not be a long trend, but there is volatility. 2 days the market goes up, 1 day the market goes down. Even for shorter periods, if the market, comes back to the same level, the fund has the ability to generate that return. In fact, just to put things into perspective, uh, the beauty of this strategy is that it works across the market scenario. So when, we've taken out certain instances where the markets were negative. So when the markets were negative, it's not that, the fund is not going to go down. The fund is definitely is going to go down, but that fall, or that movement, or that volatility will be cushioned. So if you see, we had scenarios where the market gave negative return. In most of those times, that negativity was cushioned. You had a scenario where the market is giving positive return. The fund has the ability to capture that upside. And specifically in cases where the market is range bound, and as I showed you in the previous slide also, that even if the markets were to return back to the same position, this strategy is something which will tend to get the benefit of that upward and downward movement, and yet generate return across all market conditions. In fact, just to cut the, while I'll come to the returns part, something which will make a lot of sense is that, the whole idea is that, whether this, selling and buying that the strategy does it hold good in the long term? So if you see, what we've done is that, we've calculated the returns ever since we launched this strategy. Had somebody invested 100 rupees in this strategy, that 100 rupees would have grown to a particular level, and compare it to the market movement, despite the fact that I'm only having half of the market's equity exposure. So the fact is that because I have the ability to change my equity levels, come out of equity when the markets are high or the valuations are high, I invariably end up generating a similar kind of return by
So, Varun, what you are
ensuring that
saying
during
in this slide, what I can understand what you're saying, and again, for the benefit of investors, what Varun is saying here is that if you invested in Nifty 50 index in the last 12 years, your 100 rupees became 384 rupees, getting 11.6% annual return, having 100% of your money exposed to volatility and equity. Whereas if you invested 100 rupees in ICICI Balanced Advantage Fund, your average equity in the scheme was 53.5%. So you experienced high volatility only on 53%. And even with 53% average fund in equity, your returns were better than Nifty 50 by almost 0.5% in 22 years. So to summarize this slide, by taking half the exposure of equity in the last 12 years, you have got similar returns as Nifty index. This is fantabulous, Varun.
I think, this is something which actually tells you that, whether the fact that this kind of an approach works or not. And we believe, and if you see, Brajesh, this data is a 12-year history ever since the fund started had adopted this strategy on 1st March 2010. So from that date, can I whether so again I come back to the starting point, that can I beat volatility the smarter way? Yes, we believe that there is a solution, and the solution is the balance advantage fund and the strategy. And by taking lesser equity exposure yet generating a similar kind of returns, that is something which this fund has been able to do. And we believe that in such times where you see the markets being volatile, I think if you from that perspective, this is one strategy which is a must have in any investor's portfolio, where the idea is that to get the better out of volatility, and by also ensuring that when the markets are following when the markets are falling, your portfolio is cushioned to that effect. So if you clearly see, even, and again coming back to this graph, if you see the point at during March and April 2020, while the fall in the market was very sharp, and we all went through that and we discussed the fall in this. Yes, this fund fell. Obviously, at the end of the day, it is an equity taxation fund. It will also fall if the markets fall, but the extent of the fall will be limited, and it will use that to its advantage by moving into equity. So if you see, there are two things which are working here. One, when the market fell, the fall was comparatively lesser, and at the same point in time, and this is March 2020, as I showed you in the previous example, this is a time when the equity level was the highest. So it went up as high as 75-76%, which in a general terms, if one would have thought of investing during that time, that decision would have been very, very difficult. Because it's a model and the fund does it on your behalf, you don't have to worry about volatility. You don't have to worry about the market movement. The fund will automatically adjust. So this is something which is a systematic approach which happens. When the markets are high, invariably it will reduce equity. When the markets are low, not only will it cushion the fall.
What is the current level of equity in the ICICI balance fund portfolio? People are asking, and this is very good to give a perspective.
So right now, the fund's equity level would be somewhere around 35%. And this is increasing, ever since the market has been following. And I think good that you pointed out, Brijeshji, this thing. I just slipped mentioning that this happens on a daily basis. So the equity levels which changes happens on a daily basis, and that is why when I gave that example that if 2% if the market goes down, it will increase equity by 1%. So invariably, what is happening is that in this week, and then we'll see to it at the month end when the data gets declared, you'll actually find out that the equity level has gone up, and reverse was the case when the market was continued to move up. The equity levels were gradually coming up. So this happens on a daily basis, and that's the beauty of this strategy.
Brilliant.
So that is something which is there in terms of return, and which Brijeshji also pointed out that if you see in the last 5 years, 10 years, the fund has been able to generate returns despite being less invested in the market. So if you see, it's almost 10 years that we've run this strategy. It's given a return which is equivalent to a market return, and you have a scenario where the equity participation was only half of it. In terms of the last 3 years, the fund has generated a return of 11%, whereas the broader market, and then generally, while the comparable index is something, because this invests into both equity and debt, is a index which tracks both equity and debt. But in common parlance, we generally tend to look at what the broader equity returns have been. So in the last 3 years also, while Nifty would have given you a return, and this data is around 31st of May, would have given you a return of 13%. This fund has generated a return of 11% by only participating by 46%. So the idea is to generate a risk-adjusted return, a return where it beats the volatility and uses volatility to its advantage. So that's,
sorry, continue, please.
Yeah. Even in terms of SIP returns, similar is the case with SIP returns. If you look at across periods, the fund has been able to generate SIP returns, which is in excess of what the broader markets or the index has given. And again, the whole idea is that while if you look at the strategy itself of the fund will end up doing what typically we want a SIP to do. What do we want when we invest in a SIP? That we accumulate more when the market is low, and vice versa. And that is what this fund actually does. When the markets are low, the equity level goes up. So it does that for you. So we have both the the SIP feature is also there, but in terms of the strategy of the fund, it's a very simple strategy. It will move in opposite direction to the market movement, and beat the volatility, or let me put it this way, it's the smart way of moving through volatility. And that is, as I said, that it benefits out of volatility. Buy low and sell high, very easy to discuss, most difficult thing to execute. And Brajesh ji knows more about that than me. And this fund actually ends up doing that in a similar manner without taking undue risk, protecting or cushioning when the market is falling down. And that's what this fund is. Despite enjoying an equity taxation, it's an all-season dynamic asset allocation scheme, is something which I would put. It's very difficult to decide how much debt, how much equity. This is the fund that does that in a very, very smart manner. So that's this fund, which is the fund which is all about. Like any other any other fund, you can invest into it. You can contact your Brajesh ji or any of a financial advisor, and that is something where you can invest into this fund. And from our side, the only thing is that we believe that this is a must-have in any portfolio. Brajesh ji, I think we can
perfect. So we can stop the. I will answer some of the questions. You can stop the presentation and come on the main screen. There was some interesting question which I will try to answer in the chat box. Somebody pointed out that the return of ICICI Balanced Advantage Fund is more or less same as the Nifty. There is no outperformance. This is a brilliant pointer, and I will tell you this is the whole purpose. You have been able to get returns equal to the market by taking half of the market risk. It is like, if you win, you double your money, kind of. And if you lose, you don't lose 50%, you lose only 25%. So with 25% of the risk, you are getting 50% of the upside and 25% of the downside. It's kind of that. So it's not very related, but so you lose less when the markets are down, and you make equal to the market when the markets are doing on a long-term basis 12-13% return. So that's the beauty of it. And you don't have to do it on your own. There is no taxation when you invest in this fund, and the fund is doing this on your behalf. When you buy and sell, you have short-term capital gain tax, long-term capital gain tax. But here, the company's scheme is doing this on a daily basis. So for example, as Varun said, if on Monday markets go down by 2%, they will automatically buy some equity on your behalf. On Friday, if the markets goes up by 500 points, they will sell a part of the equity on your behalf. It is too good to be true if you hear that, but the last 10-year performance of this scheme suggests by doing this activity, you may not see the result in 3 months, 6 months time when you invest in this fund, because everyday basis volatility when you buy and sell, it takes 6 months, 2 years, 3 year time to perform. But over a long period of time, the crux of the matter is that everybody wants to buy when the markets are low. This scheme does it for you. Everybody wants to sell when the markets are high and do not pay taxes. This scheme does for you, unless you sell the scheme, which you should not. And this scheme, India, Varun, correct me if I am wrong, this scheme has 35,000 crores now or more?
40,000 crores.
My goodness. So this is one of the largest mutual fund scheme in the country with 40,000 crores of funds invested in this. And if you want to know more about this particular scheme, keep pushing your question on the chat box, or the Q&A will answer that. Please get in touch with the financial advisor, mutual fund distributor who have invited you to attend this program, and he will guide you about this scheme more. He will give you more data points. And as promised, our time is up of around 30 minutes. We will take your questions if you have any. And Varun, you can also pick a few questions in the chat box or Q&A for it. Yeah.
Yeah.
Somebody is asking, sorry, please go ahead.
Yeah. So I just saw one question that somebody asked that, if you are investing into equity and debt, how does it enjoys equity taxation? So I just, try to address that here when we are talking about equity taxation, it is the gross equity level which has to be more than 65. That has always been the case. It's when we have to reduce equity, we hedge some part of the portfolio, and that is why it enjoys equity taxation at all point in time. Whereas if one does allocation between equity and debt on an individual basis, there is always that element of taxation every time you do that movement from equity to debt. Here, because of the fact that the gross equity exposure is always above more than 65%, it will enjoy equity taxation. So I hope I have been able to answer that part. This will always enjoy equity taxation at any point in time.
Chitrang is asking, we can invest in mutual fund through one-time payment rather than SIP when markets is down, so there is a chance we get more profit. You are absolutely right. So if you want to take higher risk, your return possibility can be higher, Chitrang. But if you're not sure that if markets go down, what do you do? In those situations, for those investors, balanced advantage funds are good solution. This scheme which we are talking today in this investor meet is a balanced advantage fund, and we are specifically talking about ICICI balanced advantage fund category, which gives you the advantage of reduced volatility without compromising on the returns over a long period of time. There was another question in terms of, what about, can we do SIP? Of course, you can do SIP in this fund. As Varun mentioned, the SIP returns in this fund is better than the index fund of the Nifty 50, which the index which Varun showed in the slide. So you have a choice of lump sum investment as well as SIP investment. Somebody asked, can I do STP? The answer is yes. Somebody's asking, how is it different from ICICI asset allocator fund? We will excuse that question today because ICICI asset allocator fund is not the topic of today's discussion. You can talk to your financial advisor to know more about the comparison of both the funds. That is also a fantastic fund.
So, Bridget, there's a very interesting question which I would like to cover, that whether a lump sum strategy is more advisable in this fund or a SIP or a STP strategy. Like any fund, the options of STP and SIP is available, and that is the reason why we showcase the returns of the SIP. But if you ask me from a fund construct point of view, the fund, and I covered that also while I was talking. In this fund, the fact is that the fund itself is doing that. Where you're investing in SIP, you want to invest more when the market is low. That is something which is done by the fund itself. So while yes, you have the option of investing in a staggered manner, that option is always there. But given comparatively, if you ask me, that is something which the fund inherently is doing.
Okay, Viren Patel is asking, can balanced advantage fund generate wealth or give 2-3% plus bank FD? I will answer this question. See, first of all, the regulators cannot give prohibits anyone to guarantee any returns in mutual funds. So this is not a guarantee. So I'm giving you my disclaimer before I answer this question. You see, the history of balanced advantage fund of ICICI has delivered around 11-12% return CAGR. The bank FD over the last 12 years have been 6-7% CAGR. So historically, you have got 5-6% more return. So my answer is that yes, balanced advantage fund can also generate wealth over a long period of time, but future performance is not guaranteed. It's an investor program. You should know about this. We should give our proper disclosure. There is one more question. Please elaborate the 3 elements in balanced advantage fund: equity, debt, and arbitrage. So you get equity taxation. So you pay only 10% tax after 1 year if you invest in this fund. So this is far, far better than debt funds from the taxation angle. And it happens because the fund maintains more than 66% equity at all points of time. When they say that the fund currently has 35%, it means they have done arbitrage of the balance 30% or 35%. They buy more equity. So from taxation angle, from the regulation angles, they qualify for equity. And the rest investment they make in debt funds and debt investments and arbitrage scheme. They sell the holdings in the futures market. So this is how the returns are generated. Somebody said that you are actually investing more when the markets are going up. In your slides don't match. I think you have some confusion. This is not right. The strategy is to sell when the markets are going up. Probably your that slide in which reference you have spoken about this is not correct. What is the latest portfolio of ICICI Bank? 36% in equity and the rest is debt. This is the latest. Um, uh, this is it. How is the beneficial SWP? I think this is it. What about the turnover ratio? HB Bhosle, you would like to answer that question? What is the turnover of ICICI?
I think it's a very interesting and question, and we always get this question in this fund that what about the turnover ratio? You are in between, you're moving into equity and debt. But as I showed in the slide also, and in general thing, the movement which happens from whenever the equity is going up or when the equity is coming down is 1 or 2%. You don't have a scenario where on a on a daily basis that one day it is 35 and suddenly it goes up to 65 or 75. That's not the case. The movement or the increase or decrease of equity is very, very gradual. So it does not impact that much as far as the turnover ratio of the fund is concerned. Had that been the case, where if I had shown you a graph where one day it is 30, the next day it becomes 80, then again it comes back to 40, maybe that would have been the case. But the fact that it's a very gradual movement, it does not impact that much. The turnover ratio is well within the range which is there for any normal equity fund, and that is also reflected the fact that we've run it now for 12 years as per the model. So had that been the case, there would have been those anomalies which would have come in during because there was fair amount of volatility during a lot of things which happened in this period. Hope I've been able to answer.
Yeah. Lalit Kumar is asking an interesting question. How a common man understand when to buy and what are the indications? My answer to this, Lalit, is this. A common man will never be able to understand this, and so he should invest through mutual funds and funds like balanced advantage funds, where the experts who have an experience of 20, 30 years, who have more triggers, software, systems, technology, and understanding of the market, they decide when to buy and when to sell. And balanced advantage fund also has a computer simulated model which tracks the last 10, 20, 30 years of average market performance under various circumstances. And on that basis, when those triggers suggest you have to sell, the fund sells. When that trigger suggests it's a good time to buy, historically evidence basis pe they buy. So this is the whole objective of doing this program. If you don't know when to buy and when to sell, probably you should invest in a fund like balanced advantage fund. And for more detail, of course, you can call your own financial advisor and he will be able to assist you more into this. So very good question, Lalit. And this is my answer.
I completely, agree with what Brijesh ji just said, that, and that is why we have a solution of beating it the smart way. That's how it is, because this is where something which is a model driven approach, and it will take those decisions bereft of emotions. And that is what this strategy has done for the last 12 years. And we believe that this will continue to do going forward.
So Sadhana is saying that we have 65% equity as per the fact sheet. I have gone through that. What do you say, sir? You are absolutely right, Sadhana. As we explained, because of equity taxation, you always have to maintain 65% above equity in the cash market. But then you sell 25, 30% if you want to keep lower exposure in the futures market. So you don't lose out if the markets fall. So by hedging in the futures market, you reduce the equity exposure. If you want to know more about this concept, you can ask your financial advisor. He will be really able to help you and guide over this to you. So I think true to our words, we have exceeded limit of 5 minutes, and you were very nice, all of you, to stay in the program. Any last question and any feedback of participants? How did you like the program? We will really appreciate if you can give certain feedback on the chat box. If we were able to explain the concept of balanced advantage fund, we'll keep doing programs like this in the future also. So when you get invites from your financial advisor to join us with a session with me, and we will take you through some more interesting concepts. Any final words from anyone in the chat box, and then we will close. Thank you, Mr. Bhosle, Mr. Swamini, Sudipta. Mr. RN, Pranav Patel, Raval. Any last word from you, Varun?
So, just to conclude, I think uh, the only thing which I would say is that, can will volatility go away? The answer is no. But can we get the better of volatility? Can there be a smart way of generating returns in volatile markets? We believe that, we have a model which has showcased it over the last 12 years, and the idea is that, we will continue to do that. So my limited take and my concluding remark is that yes, as the topic said, is there a way of smart way of beating volatility? Probably the answer is yes, and one of the answers is investing through ICICI Prudential Balance Advantage Fund. And that if you want anything more to know, you can please contact Brijesh ji or your financial advisors. I think they will give you and explain the product in detail. So that's all from my side, and thanks again for taking time out on a Sunday and giving us this opportunity and attending to what we had to share.
Thank you so much. So I will stay here for a few more minutes because there are people who are asking some more questions, but we'll stop the live stream right now, and the program is now officially closed. Thank you so much for joining from all across the country. We have more than 550 participants today who joined in and logged in from all over the country. It was a wonderful